Hi, welcome to Mark in a Minute. I really thought that Super Bowl was going to be a lot closer. Gosh, May, the quarterback for New England, just did not look good at all. Hats off to the Seattle Seahawks. Man, they're tough. So, we're going to talk about what needs to happen to see this rotation continue. And then we could have a really big year if we're in the right stocks. And I'm going to walk you through that, what we're seeing. And then I'm a huge fan of Stanley Druckenmiller. I think he's the GOAT. I mean, there's nobody that's been better than him. He's been wrong a lot, but my God, he's had some terrific years. 30 years of 30% a year without a down year. So obviously he's not doing 30% every year, but some years are pretty big, particularly on the downside. So we're going to analyze what his bear case is currently and how to be ready for it. Just in case he's right, how can we take advantage of this and the timing of it? So disclosures, please read through those when you have time. And then the market update. I just want to reiterate these points. Now, this is the third or fourth week in a row I've said this, but just to reiterate, until you're really sick and tired of hearing this, we think we're going to see volatility like we did last year. So it could be a period of time this year where the markets could be down 20%. That wouldn't surprise us. Now, the expectations for the S&P 500 earnings, they're high. 14% earnings growth this year. That's high. That's much above trend line. And then tech is supposed to grow 30%. Some of those names that are really starting to perform well in tech are the commodity, low technology type of companies that are benefiting from a supply demand imbalance in AI. That won't last long. They will create supply. Those stocks are going to go right back down. 3 years in a row of double digits for the S&P 500. It's really tough to do four. We could do four. That's really possible, but it's got to have some volatility with it, we believe. And then there's more stuff to buy. So we want to focus on what the market's going to rotate into. So small caps, cyclicals, value stocks, biotech. Biotech was great last year. Growth cyclicals. We've been talking about like Floor & Decor and Lowe's, those type of companies. And there's going to be some tech companies that are going to work. No doubt about it. We have some tech stocks we really like. The market needs rate cuts. So to continue this rotation, gotta have the rate cuts. So we're kind of, like I mentioned before, we're in no man's land. We've had the rotation. It's been beautiful. Some of those stocks have gone up quite a bit. To perpetuate this rotation, we need rate cuts. Now, the employment report comes out on Wednesday. So this is the delayed employment report. So we think it's going to be, somewhat weak. So we'll see what it looks like. Maybe that'll prompt the market to now discount another rate cut relatively soon if that happens. Like I mentioned, we were watching Amazon, and we like Amazon. We think that they're doing, all the right things. They reported last week $200 billion of capital spending. That's incredible. OpenAI, I don't see how those four guys have a chance. Google's going to spend 180 billion. We thought that was going to be the high spender for this year. So between the top three or four different AI companies are going to spend what's equivalent to 1% GDP growth this year. So highly unlikely we're going to have a recession with all this spending continuing to go in AI. So Amazon, actually we bought AMZU where we can. So the strategies were taking on a double on the AMZU was appropriate. So that's how confident we are in this company. It sells at a cheaper valuation than Walmart, and they are king of the hill in terms of that platform for computing power. Now, think about this. Marvell is the main supplier, or one of the main suppliers to Amazon. Marvell stock's been weak, so we picked up a little bit of Marvell as well as it's come down a little bit. Not real cheap, but they're going to benefit greatly from what's going on at Amazon. So the S&P last week was crazy. So this is a hard to really see the volatility on this chart here, but it broke the 20-day, the 50-day, hit the 100-day, bounced off the 100-day with big strength on Friday and Thursday, Friday, really Friday, but came back above the 20-day on Monday. So big movement here. It went back to going sell, sell, sell to buy, buy, buy. Kind of unusual. So you can see that it's been weakening. The market's been weakening here the last several months, and so it's all because of what's going on in tech. The rest of the market is looking good. So this is the equal weight. So I don't see any sort of dip at all in the equal weight here as with the S&P 500 has dipped. So this has been nicely strong, held above its 20-day the whole way, even though the S&P 500 dipped very nicely last week. So what else is going on? So the underlying markets have been good. Software, really, really weak. I'll show you a chart here in a second. I think it's time to buy software. And it's not the whole group, but it's just certain stocks in the software sector I think are good to buy. AI is clearly having an impact on software. So the real issue with computing power, these data centers, is that old frickin' software that was developed, 40 years ago that requires all this computing power to make it run through there quickly. There's going to be a ton of companies coming out that have artificial intelligence ready software that are going to run much better. So there's going to be displacement in the software sector, but there's going to be good quality companies that we can buy right now that are blue chip and that are going to bounce back nicely. So going through some of these, you'll see a number of these different sectors doing really well with the overall market rolling over. This is industrials. I don't see any rollover at all, huh? Didn't happen at all last week. Energy. Energy is being revalued. So everybody believes now, the market's starting to believe that energy is going to last a lot longer than was previously expected. Materials, strong, didn't come close to breaking the 20-day moving average. Here's software, okay? Software down 31% from its recent high, and we think it's hit a bottom here. So we like ServiceNow, NOW, and we're probably going to, we bought a little Salesforce CRM when it was higher, probably 20 points higher than what it is currently, and we're probably going to add to that position. Think it's a cheap stock now, and it benefits from AI. Okay, staples. Our Pepsi's done really well for us. So we're probably going to sell some of these stocks that we own here. Probably going to sell the Pepsi. Love Pepsi, but this group has moved a lot, and we just bought some Kraft. So this is important. So we think that Berkshire Hathaway has probably sold the Kraft position as Warren Buffett's retired or moved up the ladder a little bit. He's just watching now. But Kraft, we think that they've probably exited that position, or maybe they are exiting and they're probably close to being done. That stock's been crushed. So that's something that we're looking at. We buy a little bit, and the 13Fs come out here on the 15th. We'll see what Buffett what they did with Buffett's position. Now this is the Russell 1000. Russell 1000 again strong. This is the value sector of the markets. So you can see that certain areas of the markets are doing really well. I would like to see a rate cut. Some of the smaller names we think are going to just blaze forward. We've got some really good financial small cap financial stocks trading at 6 times that could easily be selling at 12 times earnings, growing at 20% a year. I'll highlight those next week. So Stanley Druckenmiller's view. I really respect Druckenmiller. I think he's the Michael Jordan of our financial services industry. Obviously, he does something a little bit different. He's a hedge fund guy. We manage some hedge funds. Our strategies that the public can buy. We can protect the downside by hedging. Generally, we don't go net short, but that's something to think about. So maybe one of our strategies will do that. When we do, we'll announce to everybody that we're doing it. But Druckenmiller, 30% returns for 30 years, never a down year. That's so impressive. He's positioned himself for a bear market. At least that's what he's saying. Later this year. The summary of his views is that we could see 30 to 50% losses this year. Why? He says the Fed is stuck. I somewhat believe that. The Fed is stuck, that they can't cut rates as aggressively as they like, but I think they will. Actually, I kind of disagree with this point, but his view is that the Fed's stuck because inflation remains high. I think the underlying inflation is probably lower than what most people think. Gosh, I hate going to the grocery store. $200 or $300 every time I go, and I don't get a whole lot. So the cumulative effect of inflation is there. So I don't think the Fed can raise rates either because it just destroys the economy. So I think over time rates are going to come down. So we would argue with this point. If you look at housing prices, housing is coming down around the country, and I think Trump's going to push real hard to get a lot of new homes built. So we got inflation and housing kind of working in the right direction. I think that opens the door for rate cuts. So, maybe Mr. Druckenmiller is right, maybe he's not. So we'll see what happens with the inflation. So the other point is that government debt's too high. Boy, is that the case. And that investors, foreign investors will start moving away from our debt into other assets. So we've seen that with maybe moving into gold. Certainly cryptocurrency tanked on the new Federal Reserve chairman that was announced. So what we're watching, and so is he. So Druckenmiller's watching the 10-year Treasury going over 5%. If that happens, you get the regional banks having big problems, big loan losses occurring, and that the credit spreads will widen with this occurring as well. That could happen. So all these things could happen. So what's the likelihood of all that happening? Well, I don't think extremely high. So we think that watching the 10-year Treasury yield is really important. It's extremely important that thing stays below 5%. Heck, it might not be even more than 4.5%, where the market will start to really have a problem with the valuations and the 10-year Treasury yield. But I think if the 10-year Treasury yield's going up, that means that the stock market's probably, the economy's probably ripping along as well. But I think his point is, no, that's just because we have a liquidity issue. And so following the credit spreads, which we do a lot. As you know, if you've been following our channel, reading Mark in a Minute, you'll see that we've mentioned this numerous times. So we had this little pop here. This little pop here caused a lot of problems in some of the BDCs that we follow, business development companies. The credit spreads are very low historically. This is 27 years. It's kind of down towards the bottom of the spread. So this is the high yield spreads minus the comparable maturity on a government bond, and we're almost around, we're somewhere around 3% on that spread. So historically, that's very low spread between junk and government debt. So the risk is that he's right, okay? That he's right on his outlook. And what's the timing? Maybe it happens this year, or maybe it's 3 years from now, right? So what we do is we use technical analysis. Now I showed you this. I showed you the chart of the S&P. So we get disturbed when we're breaking these moving averages. So if it broke the 100-day, because we're a distance away from the 200-day, we would probably complete the hedge of our entire portfolios. So put the hedge in place. We had to take the hedges down and some off, often completely in some strategies. So we protect the downside by using inverses of the S&P 500 or another index that matches that particular portfolio. So what we do in a bear market, say it rolls over like this, breaks the 100-day. Okay, we may wait until it gets to 200-day, depending on how far away it is, or like this example here, if it broke the 100-day, we'd be just completely hedged out and watching the market drop probably. But generally, if it breaks the 200-day, we want to be out of the markets. And then this is a good example. On the way back up, okay, we might find a spot where we're hitting a support level or it's way oversold, and we may take some of the hedge off to have some long exposure, and it breaks through these moving averages. We continue to increase our position, and we have a nice run in that index or in the stocks that we're looking at. So this is something to be aware of. We have great respect for his views, and we'll see how it plays out. In the meantime, we think there's a number of ways to make money. We got a lot of stocks that we like. Let me mention Anavex, okay? As you know, we like this company, focused on Alzheimer's drug. They reported on Monday. Yeah, really nothing new. We didn't pick up anything new from that, except they had more cash than what we expected, which is good. They got at least 3 years of cash. They could do another phase 3 clinical trial for Alzheimer's. The stock, what they're doing there is they're going to file again with the European Commission to get approval. I think they got a good game plan there, and we're working on comparing what they're going to file versus what they did file to measure the probability of that drug getting approved. The FDA said, hey, we're willing to work with you. Show us the data. Give us the data. So they're going to do it. So that could lift the stock very nicely. And then other things that we're focused on, I think the Kraft makes a good idea, as a really defensive position in the portfolio. We like Floor & Decor, I mentioned that. On Holdings, we think they're the next Nike. So we got a lot of names. COF, Capital One, we like that one at this level. We're picking off some of the tech stocks that have come down. I mentioned Marvell and Amazon. So lots of stocks to look at. Oh, forgot this. Grail. Did you see the Hims and Hers ad at the end of the Super Bowl? I don't know if you saw that or not, but they mentioned a blood test to detect cancer. So it's kind of a woke ad. They said, okay, all the rich people are living longer, and we're here to help. And they have this blood test that could save your life, detect cancer early. That's Grail. So we think the Grail will file in the first quarter here for approval. That blood test will get approved by year end. If everything goes well, this thing could be $200 in a heartbeat. It's currently about $100. We were in it at roughly $15 a share. So it's been beautiful for us. We're keeping the position. It's a large position in most of our portfolios. So if it works out, we're going to have some dazzling returns again this year. So if you have any questions, come to my website, Patrick Adams CFA. Ping me. You can send a note there to my email. You can sign up for Mark in a Minute as well. Also, get a hard copy of that Mark in a Minute, but also subscribe to the YouTube channel. It's a great way of keeping up what's going on in the markets, and we appreciate everybody's support. And hit like. Take care.